what if I asked you this question? The amount of mutual funds in your investment portfolio have similar stocks, only that the name of the mutual fund in which you have invested is completely different and you don't understand it. And how many of you feel that more the mutual funds, you are not diversification, you are increasing the risk in your investment portfolio? Hi, this is Anirudh Bellare here. Welcome to the 41st video of your Best Financial Life series. In today's video, you will be understanding how important it is for something called portfolio overlap secret, the mistake which is not being understood by a lot of people like you. And in today's video, I will be sharing all the secrets which I have seen in my portfolio, investment one, which has made a lot of difference to my life. And also, this is not an investment advice. Please do consult your financial advisor for any investment related advice. This is just an experience of a normal human like me who has understood the basics of investing, and I am teaching you that. So it is at your risk that you are watching this video. And also, this video is going to be very informative and knowledgeable for you. So let's move on to the first and most important point here. Now, as I asked you this question, what is the meaning of this word portfolio overlap? Now, let me write down this word here. Portfolio overlap. As I mentioned in the start of this video, the two questions which I asked you, see, I'll give you the simple meaning. You also must be knowing the meaning of portfolio. It is an investment place whereby you have the number of mutual fund stocks or whatever you have bought. And the most important thing here is this word over here, overlap, as I mentioned. Now, what is the simple meaning of overlap? You have two identical items which you are not able to understand over here. Now see, how many of you people, you have actually, before investing into any mutual fund, you have gone through something called expense ratio. Then there's something called XIRR. And there is there are particular stocks in which this mutual fund this mutual fund industry invests into. So say for example, there are like around 150 stocks. Now this is solely with respect to the Indian market. Now these 150 stocks over here, as a person who is new to a mutual fund industry or an investment industry, I'm saying example for your case, asking your financial advisor about all of this will become extremely crucial here. Now, sharing my story from all of this, what I'm trying to tell you with this concept is, see, say for example, there is a mutual fund named A. Okay, this is just a random example. This is not any investment advice here. Please remember that. Now, this A mutual fund has invested into, same example, 150 stocks. And being a salaried person, I take out 1,000 rupees or say example 2,000 rupees and I invest into this mutual fund. Similarly, after 6 months, when I feel that I have more amount to invest, I put another 2,000 rupees into B mutual fund, which has, say for example, 120 stocks. Now, if you notice what is happening over here, there's something called overlap, as I mentioned. Look at this, 120, 150. Now, when you actually go through what are the stocks the mutual fund is investing in, and if you find there are at least more than 10 or 20 which are like repetitive in both the mutual funds which you have invested, then do you know what, my friend? With time, you may feel that you have diversified your mutual fund portfolio, but in reality, both will work similar. As a result, what happens? You will see your returns on a similar basis. Now, whether it is good or bad, you decide it, because you are the right person for your portfolio. What I can tell from what I used to do as a mistake was that when this used to happen, I always used to get a thought, if mutual funds together, any mutual fund which I choose has invested in 100 or 150 stocks, and if I buy another mutual fund, as a result, what happens? It is harming my own portfolio, because the growth which I can get in one company, I am sharing the growth in two of the mutual funds invested by me, because of which it becomes a problem in the long run for me. It could not be true for you, may not be, but for me, this is what was happening. And when I realized this, I understood that it is not too late. There is still time. You can take out time and rectify this mistake. So what I did, I removed my amount of 2000 rupees from company B, that is mutual fund B, and I invested the 2000 rupees in the mutual fund A. As a result, what happens? Looking at the rolling returns. Now, what is this word named rolling returns? It is an overall returns period from the time the mutual fund had been launched. Say, for example, this fund named A had started in the year 2010. Now, from 2010 September, say for example September, 2010 September till 2026 June, how the mutual fund has performed over all highs and lows, whether it be COVID crash, whether it be government change, or whatever war or whatever volatility you would have seen in the market, the same thing you would have seen in your portfolio, mutual fund one. As a result, what happens? You will know what you are eventually wanting to do in the market. Now, what do I mean by this? See, with time, what happens? You obviously will be knowing, like I mentioned, the rolling returns. Yeah, so the rolling returns point over here was that over this period of time, what is the average percentage you can expect in your long-term compounding process, which can come to anywhere about 12 to 15 percentage, which should be fair enough. If your money can compound anywhere between 12 to 15%, it's considered very, very good. Now see, this is just a normal example over here, but the idea of making this video was to make you aware of this concept, because not a lot of people know this, and it eventually harms them. Now see, also considering the fact that your current age right now, the current risk you are wanting to take, and what are your future goals with that mutual fund investment. Are you going to plan to do something called systematic withdrawal plan, whereby when the corpus hits your money goal, which is, say for example 5 crore, when your corpus hits 5 crore, you very well know that every month you would be needing around 1.5 lakh rupees to be credited in your bank account, so that you can sustain your monthly income very well. Monthly operations as in your day-to-day work, day-to-day expenses. If you are very clear on this, from the 5 crore corpus, your 1.5 lakh keeps getting credited into your bank account, and the 5 crore keeps compounding on itself, whatever is there in your investment account. So this is how it works. So the answer here is by you being clear on what are your particular needs. See, I'm not telling what this overlapping concept is incorrect. It solely depends on you. You feel it is right, you may choose to do it. You feel it is not right, you may choose not to do it. Now let's move on to the next important question in this aspect only. Also, this point becomes very important now. Now, why does it become important to track your overlap? Now, this is your important symbol to track overlapping. Now, see, as I mentioned, pardon me if my spelling is incorrect here, but why this turns out to be very important. As I mentioned, two companies A and B. And what did I say? 150 stocks, 120 stocks, and both common. There are around, say, 30 common stocks. Now, as I gave you a choice, it's your wish. You want to choose to invest in both A mutual fund, B mutual fund, it's solely up to you. But now, as I mentioned, why does it become important to track your overlapping is for this important reason, that these 30 common stocks over here, which both the mutual funds have invested in, if you identify something, there is this term called sector. Now, what is the meaning of this word sector? A simple example, you have something called the banking sector, where you have typical banking type stocks. There is something called your solar sector, where you have all solar related stocks. You have your pharmaceutical sector, where you have all pharmaceutical based stocks. Now, the sector means a whole as in a big, I'm not able to get the exact English word, but it's a place where you have all similar related companies in that particular place. Like as I gave an example, like your pharma sector or solar sector, whatever. Now, if at all you go through and you find out that A mutual fund house and B mutual fund house has, for example, say, they have invested in companies which are in the pharmaceutical sector. And despite the sector being same and the stocks being different, that also becomes important. Why? Now see, with all these geopolitical fluctuations which are happening right now in June 2026, it becomes important for you to know that in the current reality, whatever sector, it could be going through a lot of volatility. As a result, what could happen is, if one particular sector is not performing well, eventually your mutual fund may not perform well in that present scenario. In the long run, it may eventually do well, but in the present scenario, it may not perform well. So why this becomes important here is, if you very well know that there is a sector which is repeated in both the mutual fund house, then it is better for you to choose only one mutual fund house instead of the second one. This is also an important learning. See, I might have told this point again and again, but it becomes important for you to note this point, because a sector, as I said, it's a whole, it's a place where you have different type of companies which fit in that sector place. And if there is a repetition, it could be a problem for you. Now see, in the long run, what happens, you may feel that the amount diversified between both the mutual fund houses will eventually do well for you. But as I mentioned, it solely depends on you, your current age, what do you want to do with that mutual fund earning and all of that. See, this is not any promotion of investing in any mutual fund or whatever. I have done it in my life. I have made the mistake of investing in two mutual funds, and I've understood that this sector problem, the sector related issue is there. So I removed my money from one mutual fund and I added it to the main mutual fund, which I feel will eventually do well as the rolling returns are exceptionally good. Simple. So this was the point I was trying to convey. So let's move on to the third point. Now there is something called your high management fees. Now what is the meaning of this high management fees? Now see, as I mentioned, you have invested in mutual fund house A, mutual fund house B. Now what happens is, because mutual fund is actually managed by active portfolio managers, they keep buying, selling, or they decide what to do with those particular sectors or stocks. The fees which you pay as a normal investor will go up, because eventually, if say for example mutual fund house A takes, say for example 10 rupees per whatever you buy, and house B also takes 10 rupees, and you very well know there are repeated stocks. Now see, it's not a concept of penny wise pound foolish here. It's about, you very well know that which mutual fund will eventually perform well on the basis of your rolling returns. You can check rolling returns while from going to Google and actually typing your mutual fund name and going through. So why pay all of this when you eventually know what is going to benefit you? See, the whole ideology of this video is, there is something called, like I'll give you an example. If you love to play a sport, like say I love to play cricket. Now in cricket you have a bat, you have a ball. Now you very well know with the bat you can hit a 4, you can hit a 6, you can hit 2 runs, you can take 1 run. And with the ball, your goal is to eventually make the batsman out. Despite all this, there is something called cricketing sense or game sense. When to take the single, should I hit the bowler right now on this ball or not? Should I wait for the best bowler? Now what happens here? This is what is called cricketing sense, where in the moment you take those decisions which will which you eventually would have not thought of. Same thing when it comes to investing. You may be seeing the rolling returns, you may be seeing the active managers, the name of the people who are managing the mutual fund portfolio, and all of that is good. But for you to have that investing sense, which will come with time, or you can learn from your financial advisors, or there are a lot of people to learn from. If you know this in the investing sense, like how, now what are the types of investing sense I'm telling? Like I gave you an example, one is overlapping, one is knowing there's something called XIRR, expense ratio, and the fees you have to pay to your active portfolio managers. Now these are small things which actually make a difference. If you actually go and Google them, you will get to know a lot. And there are many more things like this. See, it's all about being a part in the game. Whether it comes to your investments or whatever you do in life. If you follow cricket, you will be knowing the concept of test match, whereby players play at least for 4 to 5 days till the match gets over. Even though it's a very elongated match, it's a huge match which goes on for 4-5 days, your investment should also be considered the same. Not 4-5 days, fully depending on what are your needs. Could be 5-year plus or whatever. And that is why it's important that with time you get this investing sense. I hope you really liked this video. If you did feel that you have got value from this video, as I mentioned, portfolio secrets. Now, the word secrets which I mentioned in the start is this. This is the biggest secret. What else do you need to know? There are many things like this which will eventually make you a better investor. And always remember, please take your due advice from your financial advisor. It will be perfect for you. As I mentioned this, thank you so much for watching this video till the end. If you did get a lot of value from this video, you can do thank me in the comment section, or you can do share this video to a lot of people. For those who invest in a normal basis or on a monthly basis, these small investing sins become eventually important in the long run. And it's the small mistakes which are actually the game changers in the long run. You may not know it, but it will eventually happen. Thank you so much once again for your valuable time in this video. Thank you so much.